This video is for educational purposes only, not financial, tax, or investment advice. Always do your own research before making money decisions. In 2007, Warren Buffett made a $1 million bet. A plain S&P 500 index fund would beat elite hedge funds over 10 years. Those hedge funds had superstar managers, world-class analysts, expensive algorithms, glossy track records, and clients paying enormous fees for supposedly superior expertise. Buffett had one boring index fund, almost no drama, and a strategy so simple it sounded embarrassingly unsophisticated next to Wall Street. 10 years later, the hedge funds returned 36%, while the index fund returned 125%, exposing a brutal gap between sophistication and results. So the real question is not whether professionals work hard. It is why their expensive effort so often loses to simplicity. By the end of this video, you'll understand what Buffett understood and why Wall Street rarely emphasizes the math behind passive investing. Wall Street has sold actively managed mutual funds for decades using one seductive promise: pay experts, and they will grow your money faster. That pitch sounds logical because, in most areas of life, professionals usually outperform amateurs, whether in medicine, law, engineering, or accounting. But investing works differently. After fees, professional active management usually delivers worse outcomes than the cheap alternative investors were taught to ignore. Active funds employ analysts, portfolio managers, research teams, data systems, and powerful technology, all dedicated to finding stocks that beat the market. These people are not lazy or stupid. They are intelligent, skilled, motivated, and deeply committed to outperforming, yet the results still disappoint. SPIVA data shows that across most 15-year periods, roughly 88% to 92% of actively managed U.S. large-cap funds fail to beat the S&P 500. That means nearly 9 out of 10 professional managers, despite immense resources, trail a simple fund that merely owns America's largest companies. And this pattern is not limited to one market cycle. It repeats across decades, countries, asset classes, and different categories of funds. The first reason is cost. Active funds charge management fees, trading costs, and sometimes performance fees that quietly drain returns every year. A 1% fee sounds tiny, but on a growing portfolio, it removes thousands of dollars and destroys the compounding investors needed most. The second reason is overtrading. Active managers constantly buy and sell, creating friction through spreads, commissions, and taxes in taxable accounts. Index funds barely trade at all. They mostly sit still, update occasionally, and allow more of the investor's return to remain intact. The third reason surprises people most. Institutional investors collectively are the market, so as a group, they cannot outperform themselves. When most trading is professionals competing against professionals, average institutional results equal average market results. Then fees push the entire group below average. This is not a conspiracy or secret trick. It is a structural math problem, and the math becomes devastating once fees enter. Wall Street sells this underperforming product at a premium price, while the cheaper, better alternative often receives far less attention. So what is an index fund? It simply tracks an index, automatically owning companies in the same proportions as that index. An S&P 500 index fund gives you tiny ownership stakes in 500 major American companies without asking you to pick winners. No stock selection, no forecasting, no manager intuition, no dramatic baits, just proportional ownership of America's biggest publicly traded businesses. When a company grows, your fund benefits. When a company shrinks or falls out, the index replaces it automatically over time. That self-updating structure is powerful because you are not predicting which firms survive. You own the changing winners as the economy evolves. The first advantage is cost. VOO charges about 0.03%. Meaning you pay only 3 cents annually for every $100 invested. Compared with active funds charging 0.75% or 1%, that gap may seem small now, but it compounds into tens of thousands later. The second advantage is diversification. With one purchase, you instantly own companies across technology, healthcare, finance, energy, consumer goods, and more. If any one business collapses tomorrow, the effect on your overall portfolio is tiny because your money is spread across hundreds. The third advantage is tax efficiency. Because index funds trade very little, they usually create far fewer taxable capital gains distributions. Active funds can trigger taxes even when your account is down, because managers sold winners internally and passed the gains to you. The fourth advantage is simplicity. You do not need to study earnings calls, predict rates, analyze executives, or guess the economy. For most investors, simplicity is not a weakness. Fewer decisions usually mean fewer mistakes, lower costs, and better long-term results. Now let's look at the proof. From 2003 through 2023, the S&P 500 returned about 9.7% annually despite multiple historic crises. Over that same 20-year period, the average actively managed U.S. large-cap fund returned about 8.1% annually, just 1.6 percentage points less. That difference sounds trivial until you put real money behind it and let time magnify the gap between average and slightly below average. $50,000 compounded for 20 years at 9.7% grows to roughly $316,000 in the index fund version of this comparison. The same $50,000 compounding at 8.1% reaches only about $239,000, creating a quiet but devastating shortfall of roughly $77,000 overall. That money did not vanish in one dramatic crash. It disappeared slowly through underperformance and fees while statements kept looking mostly normal. Sometimes an active fund beats the index for 5 years, and investors rush in believing they found a manager with lasting skill. But research shows past winners have no reliable advantage in the following 5 years. Most outperformance is random variance wearing a suit. Even Buffett, the greatest stock picker alive, has repeatedly said ordinary Americans are best served by a low-cost S&P 500 index fund. In his own estate instructions, Buffett told his trustee to place 90% of his wife's inheritance into a low-cost S&P 500 fund. If the world's most successful active investor wants his family using index funds, that should make everyday investors stop and think. Now let's focus on fees, because most investors understand percentages intellectually but never truly feel what those percentages steal over decades. Imagine investing $500 every month for 30 years in a low-cost S&P 500 index fund charging just 0.03% annually in fees. That investor ends near $1.1 million and pays only about $1,200 in total fees over the entire 30-year period alone. Now compare that with an active fund charging 1% annually, which is actually modest by the standards of many active funds. That investor finished around $870,000 and pays roughly $231,000 in fees, ending with about $230,000 less wealth by retirement overall. They paid a fortune for the privilege of underperforming, which is why high fees are not a detail, they are the story. And those fees are rarely framed honestly. They appear as tiny percentages in prospectuses, even though their lifetime impact can reach 6 figures. Your money also funds the machinery behind the fund: analysts, offices, sales teams, celebrity ads, and every polished marketing campaign you see. Some funds even charge 12b1 fees, meaning investors literally pay for the advertisements and distribution systems used to keep selling them. Others add short-term redemption fees, effectively charging you for leaving too quickly, because the structure is designed to preserve fee revenue. None of this is illegal, and technically it is disclosed, but the information is buried where few ordinary investors ever read. So if you want the simple alternative, the setup is straightforward. First, choose the right account type for your situation. If you have earned income and qualify, open a Roth IRA, where growth compounds tax-free and qualified withdrawals stay tax-free. If your Roth is already maxed or your income is too high, use a taxable brokerage account instead and keep investing. For U.S. investors, Fidelity, Vanguard, and Charles Schwab are all excellent brokerages, and choosing among them matters less than opening one. Fidelity is beginner-friendly, Vanguard pioneered retail index funds, and Schwab offers a strong platform if you later want broader investing tools. At Fidelity, FXAX tracks the S&P 500 cheaply. At Vanguard, VFIX works. At Schwab, SWPPX is excellent too. All of these funds track the same market index, so the perfect choice matters far less than actually making a choice. Once you choose, set up automatic monthly investments from your bank account, preferably on a fixed date you won't constantly reconsider. Automation is powerful because it removes emotion, hesitation, market timing, and the temptation to spend the money before it gets invested. Then turn on dividend reinvestment, often called DRIP, so every dividend automatically buys more shares and quietly accelerates compounding over time. This strategy does not require predictions, constant monitoring, or special insight. It requires low costs, consistency, and the discipline to leave it alone. Here is the core takeaway: the expensive, sophisticated product Wall Street markets most aggressively usually loses to the cheapest, simplest alternative. Buffett knew that active managers compete in a game where fees, friction, and arithmetic make long-term outperformance incredibly difficult for almost everyone. That does not mean every active fund fails every year, or that professional management is useless in every possible circumstance. It means that for ordinary Americans building wealth over decades, the simplest strategy has produced the most reliable evidence-backed result. A low-cost S&P 500 index fund, automatic contributions, reinvested dividends, and patience. That is the whole strategy for most people today. No stock screener, no earnings call obsession, no prediction game, and no advisor charging 1% to explain what the data already proves. If this changed how you think about your money, subscribe, leave a comment, and take 15 minutes to set up the simple version. Subscribe for more personal finance breakdowns, watch the next video on screen, and let your money compound with the simplest strategy available.